Okay. Let's quickly get into this. If you understood CAPM, if you understood single index model, these things are quite easy. It is an extension of those things. Okay. Maybe today after the session, I will not be available. If you have any quick question, you can ask me during the class, or later also you can post me or message me. Okay. So beta is a single factor model or multi-factor model, CAPM. CAPM, which we have seen before the break, is that a single factor model or multiple factor model? What do you think? It's single model. If you remember, the formula was expected return is equal to risk-free return plus beta times market return minus risk-free return. So we are using only one factor, that is market. Okay. So market returns are the influencing factors on your investment returns. But here, people who criticized CAPM, William Sharpe's CAPM, they came up with more models as an extension, criticized for a factor for a reason, because they have another point to add. That's how multi-factor models have emerged. So, like I told you about a regression, running a regression using single index, you can do that for CAPM. You can do that for these models also. But in this session, right now, we'll be understanding what exactly they are, how they're different from CAPM. Okay. So multi-factor models, to start with, I think if you remember when I gave you the data, I told you risk-free return for 60 months, 5 years, 60 months I gave you, that is not the same. I think that's what we have seen, right? Did I close that? Yeah, this one I'm referring to. A treasury bill rate, which is referred as a risk-free rate, it's not actually risk-free. It is also risky. Could be less than market return. So this point is discussed here. There is something called two-factor SML, security market line. It is part of CAPM. So again, a simple task for you, looking at these equations, can you just tell me what's happening with these equations? Either this or this, you can take anything. How this is different from CAPM? Yeah. Twice. CAPM twice, okay. So why it is once there, twice here? Okay. So if you look at this, closely follow this, we have used the same expected return which we have used, or historically we use this. If it is expected return, we use this. If it is historical, we use this. Okay. So you take anything. This whole thing we have seen in CAPM model is already there. What we added is this. Okay. Importantly, this, if you look at this, this is about market and this is about treasury bill. We added treasury bill. So treasury bill also has a risk factor. So let us take that also as a regressor, as an independent factor influencing returns, my returns. Okay. That is the addition we did it here. If you want to elaborate that, the market premium is this. Okay. The risk-free premium is this. Okay. So expected risk-free premium minus expected risk-free rate in future minus risk-free rate will give you the treasury bill return for our model construction. So it is simply sum of risk related to the market and difference between expected return and risk-free return. Okay. If it is the same, whatever the risk-free rate we had today or 1 year back, and it is going to be the same in future, we don't talk about this. There is no discussion here. That is also changing, so we are talking about that. Okay. Is this clear? Two-factor model. Okay. And if it is clear, let me move on to the next one. Fama French three-factor model. It's so popular. Many portfolio managers, mutual fund managers, researchers, they use this model. Okay. Can you again, same question to you all. This is Fama French three-factor model. How this is different from CAPM? Can you make it out? Can you give your views? Yes, Walker? How many? Actually, it added 2 more. Total 3, right? 3 times. So if you look at that, again, this is the same as we discussed in CAPM. There's no difference. It's the same. What we got added, this is 1, this is 2. These are the 2. Same equation, same regressions, same process, but we added 2 more factors. So what are they? So what Fama French in their research they say is, along with the market risk, the size of the firm. Say, for example, I think today's class we started with that. How top 3 are different from General Mills. They're running in trillions of capitalization. I think there's no difference between market and these 3 stocks: Microsoft, Google, and Nvidia. So Fama French rightly picks up that point. Size matters. And not only size, the value. Usually when we assess the returns, we always look at in the dividend models, in dividend discounting models. We have seen that to find the value of a stock, we discounted future dividends to present and said that this is the value of a stock. So what Fama French says is, for your returns, to arrive at returns on your investment of a stock or portfolio of stocks, you should know the market risk, you should know the size of the company where the stocks which are dealing about, and the book to market ratio, which is more popular. That is also important. So what is book to market ratio? It is BPS compared to MPS, book value per share divided by market value per share. That is your ratio. Okay. So if the ratio is high, what does that mean? The company has good assets. Even if it is getting liquidated in terms of bankruptcy or something, it has good salvage value. If the book value is low to market value, it means it is worth of nothing. I think construction companies, capital intensive goods companies, construction companies, their book value, book to market ratio is high.
Out of the 3 we've done so far, this is the most accurate for finding stock returns, this 3-factor model?
No. Let me complete. I'll give the important how it. I think if you remember, if you go back, we have seen market return alone as an influencing factor here, in influencing your investment returns. But Fama French says not just market, you should also take two more factors which will influence your return. So how do they influence? The first factor is the size. Bigger the size, more is the influence on your returns. The $1 trillion market cap companies are the example. Lower the value, less is the influence. That's the idea. Higher the value, more is the influence. That is the second factor. So this is the first factor, market factor. This is the second factor based on the size. Okay. Then the third one is the book to market ratio. Small companies and large companies, there is huge difference. You'd be surprised to know there is something called January effect. If you're interested, you can do that. Take positions in the month of December. Buy stocks of small cap stocks. They will do well in January. Okay, that is the calendar effect or market anomalies, we call it as in investment research. Small size stocks always perform well in the month of Jan. Keep an eye, and if you're interested, do some homework and pick up some good small stocks. Put some money, $5,000 or $10,000 or $20,000, whatever, minimum at your end. So this is three factor. Walker, you got that point? These are three different factors which will be influencing your individual returns. Let it be your own personal investment. For example, if it is your own stock, independent stock, you have to consider all these factors. And this is more important for a portfolio. Portfolio is important. So this is a Fama French. So what they usually do is they see the difference between small and big companies and high valued and low valued stocks when they run the regressions. That's how they arrive it. So this is an innovative approach to inculcate a risk factor into investments and very popular. This is Fama French three factor for you. And the same thing, if you remember, we have seen this in the single index model. This is a kind of error term or residual when you run the regressions. And when you run the regressions, you will be getting individual coefficients for these three factors. Okay. Then there is a comparison of using single index model and three factor model. We have seen single index model, which is running regression of the difference between stock and the risk-free. The difference between the stock and the risk-free. This and this. Difference between this minus this. This is the dependent variable. And its influence on difference between this and this. It's what we have seen. So we are discussing again the same here. That is about single index model and three factor model. Okay. Now, maybe let me go back. When you run the regressions, you will get a beta value. If you look at the screen, for example, market beta is 1. What does that mean? You also have a risk-free return is 4%. You said 4%, right? Treasurable. 4% plus 1 into, say, market return is 12% minus 4%. So what is R? What is the expected return? Can you give me a quick answer? 12. So 12 minus 4, 8 into 1 is 8. 8 plus 4, 12. That's how we regressed. We forecasted the return. We got it using single index model. Okay. But in three-factor model, we have not just that, we also have another factors. But simply looking at the screen or the board or in the textbook, it's quite easy. But in reality, you may have different numbers. Maybe this could be -12. Okay, so it is all about this beta. If beta is 1, accordingly times this plus this will give you the return. But in a three-factor model, which is a multi-factor model, you will have small minus big as well as high minus low. Okay, small firms minus big firms values, I'm saying high minus low, high book value minus low book value. That also you'll have. So moving forward, we have an example here. This is the coefficient alpha. Don't get confused with the Jensen alpha. That is different. We use for a different purpose. This is the intercept of the constant here. Okay. In single index model, they have given some regression analysis, which we couldn't do it in the class because of the add-ins are not available on the screen in Excel. So we have something which is already done. Okay. So if you have the result like this, what does that mean? The answer is in single index factor, the answer is 2.080. Let me go back. Just look at the screen, all of you, please. We are just talking only about this one. If you consider only market return, where we have used single index factor, the beta is 2.080. What does it mean? It means that if a market increases by 1%, your investment returns will increase by 2%. That is how you have to interpret beta coefficients in your regressions. Did you get it? If, say, for example, market, the beta is 0.50. 0.50. What does that mean? If market return goes up by 1, your return will go up by 0.5. Okay. Sometimes the coefficient could be negative. Say the answer is minus 0.75, negative 0.75. What does that mean? Market is up by 1 unit. Your return will come down by minus 0.75. Inverse relationship. Okay. That's what we are looking at here. We have something called 2.080 as beta in single index model.
That actually,
it keeps changing based on your data. I don't know which, if I'm not wrong, Bodhi always does for till 2022. Most of the data is till that time. Maybe he did it for 5 years back, 2019 to 22 maybe. Okay. So I think the same data was used, which I shared in the canvas. So this is the intercept. So how to use the intercept actually? So minus point, can you quickly give me the answer for this? Plus 2.080. What's the answer for this?
1.752.
1.752. Okay, if that independent factor goes up by 1 unit, your investment return will go by 1.752. As simple as that. Okay. So again, these are some statistical calculations, show you some significance. This is very significant. Sometimes you may get good regressions, but statistically they're not significant. You have to ignore them. Coming back to three-factor model, if you look at this, let me erase these things. So this is 1, this is 2, this is 3. Now we have, let us look at 3 factors. What is the first one? What is the first factor? CAPM. In CAPM, what was the factor? Market. First factor is market. Second factor is size of the firm. Third factor is book to market. So if the author calculated for this also, this is the intercept, constant, and this is the market beta, 1.921. Same data, same period. See, we got 2 here, 2 plus here. But when you added these two, SMB and HML, its values come down. It means that when you add more factors, the single influence will come down. Okay. So that's the reason many criticized CAPM just going alone with the market as influencing factor for your investments. You should also add more risky factors. Here in this case, they have it 2, and SMB, which is small minus big, it has given a beta of 0.916. And HML, high minus low, has given a value of 0.799. So can any one of you add these 3 and deduct this because this is negative? If that is positive, you will add all 4. And they're all are significant, statistically significant.
3.64.
3.64. So when you have taken only this, how much you got? 1.7752. And when you have taken 3 factors, 3.64. Okay. So now you are more sensitive to 3 different factors. This means that independently, when you mix up all these 3, your return will go up by 3.64 for given change in 1 unit of these 3 factors. Okay. This is how the regressions will help you in forecasting future returns. So we had a comparison of single index model and 3-factor model. Is it clear? Okay. If you have a question, you can ask me quickly. And finally, the last one for the day, arbitrage. Have you heard about this? Arbitrage? Any guess? What is arbitrage? Arbitraging between 2. In law, in investments, yeah.
Not only do the 2 investments to account for the other ones, do that.
Are you talking about portfolio? You're right. You're talking about 2. That is perfect. It is between 2 for sure. Okay. So whenever there is a price mismatch, for example, Google is getting, it's a wrong example. If you take a stock which is very illiquid, okay, it is not active. It is trading at, say, $20 in one market and getting traded at $21 in the other market. Then there is an arbitrage opportunity. Sell there and buy here. Easy money. Easy money, free money rather. It is free money. There is no investment here. You're not borrowing like buying on margin calls, shorting on margin calls. You don't have to do it. You not pay to the broker or someone. Just sell there, buy here. But it's not that easy. Like you knew this, everyone else will get to know about it. Quickly, it will get discounted. It will be equated. So to make free money, you should be an expert in observing the prices. You should have a software for that. And moreover, that should be above the transaction cost also. Basically, yeah.
That like selling the call option and getting the credit.
No, call option is different.
But like getting the credit premium and then.
No. Nothing. There is no mechanism at all. Right? The same asset sold at different prices in different markets. It applies to anything. Say gold, you buy gold in US, sell it in China or India, something like that. Because price differences. You buy oils in US, sell somewhere else in other country. Arbitrage opportunity. Okay. In stock prices, you can't get that with index stocks. It's very difficult. They're always well balanced. But non-index stocks or penny stocks, you may have the opportunity. You can try that. Okay. So coming to arbitrage pricing theory, they say that risk-return relationships from no arbitrage considerations in large markets, capital markets. And there is no systematic risk which is negligible. You can have arbitrage portfolio, positive return, zero net investment, risk-free portfolio. Is simply called as zero money, free money rather. Nothing is there except your brokerage or transaction charges. Okay. That is arbitrage. So arbitrage pricing theory, it is given by Stephen Ross. What it says is, again, based on CAPM model, it uses the same. What it says is there are always arbitrage opportunities when an asset is undervalued compared to the same asset which is overvalued somewhere else, the price differences. Okay. He has given the example of, we use the same in single index model also, if you remember. Okay. This is the example of a stock, Intel, and some funds are also given here with some regression line. Regression lines need not look the same way we have. They may have different lines. Okay. I think these are some of the multiple factor models with the risk-free and risky. Fama French 3-factor model and APT. Some interpretations. More on this. So we have been repeating the same. CAPM is a single factor model. What is a single factor model in CAPM? Market. I keep on asking that, it's very important. Market.
What does arbitrage pricing theory add on to the 3-factor work?
We are discussing. We didn't start yet. So it is a multi-factor, first of all. It is a multi-factor generalization. So it uses beta relative to the market portfolio to explain the returns. What the difference here is, it allows multi-macroeconomic or company specific. In case of CAPM, it is very clear and specific. Yes, it's market, nothing else influences your returns. In case of 2-factor, risk-free and market. In case of 3-factor, it is market return, HMB and SML. They're fixed. But in the case of arbitrage, you don't know. But you know a factor is influencing. So that's how Ross calls it as macroeconomic factor, which is external and uncontrollable, or company specific factor, which influences your investment returns. But it does not specify which factor is that. Maybe that differs from stock to stock, portfolio to portfolio, industry to industry, it differs. Okay, he did a very good research on that, proving this point. So the value addition to this is, in those earlier models, they are specific, known to all of us, but in this case, we don't know. We need to find it out which factor is influencing what. Say for example, he just names it as, this is RM1, RM2. In the case of CAPM, we call this as market beta, and others are other betas. But here we don't know. RM1 could be market, RM2 could be some inflation, RM3 is interest rates, RM4 is GDP, RM5 is SMB. We don't know. Okay, so we can't have a standard specification that this is your risk factor influencing your individual asset return. That's the difference between other models and arbitrage. So why it is like this is because it accounts the credibility of risk influence to various sources, which is in a systematic form. So the systematic risk is not just one, but multi or many and not known. So it straight away hits beta and says, that's not the right way, this is the right way. Okay. I think I don't want to go more into it. You got the difference? CAPM, single index, two-factor model, multiple index, APT. Okay. APT is a final extension. We have many models, but in this academic fraternity, these are the popular models which we will be using for a basic understanding of portfolio theories, to understand the risk return behavior and forecast the future value or future returns. Okay. Is it clear? Is that okay? Walker, did I answer your question? Any other question you have? You can quickly ask me. Yeah.
Are you gonna post the video of you,
Of?
you were gonna give us an example of a single S&P.
Single index model, is it?
Yes.
We have done that.
No, you were gonna show us a video of how to do it.
No, I said that I will make a video and share that with you. I thought I can do it on Excel, but it's not working here, so that you guys can understand. That's quite interesting. You will know what is the intercept, what is the coefficient, what is the statistical significance. Everything is explained. You will get ANOVA table, you know, they're so clean and clear. I'll do that. Give me some time, but that will take some time. And by the way, is there any question on this before I stop?